Hey guys, it's Justin Goodbread here with Financially Simple. So I'm in the studio and I'm going to create a little video here for you. We've been working a lot in the last few weeks, few months. My earphones always make my glasses come down. I don't know why. But anyways, we've been working a lot in the last few weeks, months with tons of different CPAs, tax attorneys, enrolled agents, EAs across our country for many of our clients. And I put together a list here of 18, 2018, 18 things that you could do as a business owner, and perhaps maybe you're not a business owner and you're watching this. Here's 18 tax saving tips that you can do before year end that could save you thousands of dollars in money. In some cases, hundreds of thousands of dollars in money. I'm going to give my disclaimer right now. You know, I'm not a certified public accountant. I'm not a CPA. I'm a CFP, a certified financial planner. What I'm dealing with is how financial planning and tax planning can help minimize your taxes for next year. So think planning, tax planning next year. I heard an interesting statement this last year whenever I was at the Certified Financial Planners meeting, which is called FPA, Financial Planning Association meeting. One of the top tax attorneys in the country said, folks, you CFPs in the room, you are going to be the leading tax planners this year and maybe for the next few years, because so many certified public accountants have been working in 2017, the old code, and they're just now digging in. They're trying to take as many continuing education courses they can to understand the new tax code. Whereas we haven't been thinking about the tax code from last year. It's done. We're not worried about that. Planners are looking at this today going forward. What can we affect in the future? So folks like myself, we've had our heads in this code, reading it, deciphering, writing things about it. If you've visited the blog Financially Simple, you've probably seen me write multiple things about this. I've been taking IRS publication release notes and putting my interpretation on it. Again, I'm not a CPA. I'm not a tax attorney. I'm a certified financial planner who specializes in working with business owners and showing you how to build wealth. So today, any of these 18 things, please do not construe this as advice. It's not. I want you to talk to your CPA, talk to your tax attorney, and say, hey, look, I was listening to this kid named Justin online. He said I had to consider some of these things. And let them tell you. They're the ones who know your life. Let them tell you whether or not these things work. So that's my disclaimer. With that being said, let's jump into 18 things you can do as a business owner right now. And again, maybe not all business owners, but here's 18 things you can do right now. Now, some of these you're running out of time on, and hopefully you can make some adjustments. But here's what we've been working with on our clients for the last little bit. One more thing I'm going to tell you. If you do not have good books and records, shame on you. There's no way that you can make calculations on how to reduce your taxes. One of our top clients that we work with, this gentleman's going to make like just over $1 million of revenue this year. He's looking at a $400,000 federal tax bill. Forever, he didn't have books. I finally got a CPA who's been begging him to do this. His CPA is now doing the books. Today, I've been on the phone with his CPA, and he and I have been looking at saying, hey, here's some ways we can make some adjustments. And we're on the same page. We're working together, bouncing ideas off each other. So you need to have your books up to date. I have a couple of clients that I ask them, I need your books. I need to get a CPA. I need to get a bookkeeper. And I can't help them because the numbers are so messed up. I don't know where they're at year to date. So what I'm telling you is, if you're trying to save tax dollars, you have to have very good up-to-date records. Because number one, let's jump into these. Number one, if you're looking at a particular area of the tax code and your particular income, and you're trying to reduce or prevent from incurring any more taxes, then you could, number one, stop billings and collections. If you're in a cash-based business, then you may delay accepting some income from a job that you're currently working on because you've had a banner year. If you don't know where your books are at, it's hard to judge that. If you're on an accrual basis, then you may stop billing. You may just not. It depends on which type of a basis you're working, whether it's cash base or accrual base. But number one, the first thing you can do is you can stop billing and you can stop collecting today. You can push that income into next year. Okay. The second thing you can do is you can prepay some expenses. This is something that we often use. So I have a client who likes to change tires on his semis every January. And so what we're going to do is we're going to go ahead and pay for the tires this year. and then we'll install them in the first 2 weeks of January. So that's an expense that we're going to incur in the early phases of next year. We want to go ahead and pay for that now. We want to go ahead and pay for that expense now and incur it in this calendar year 2018 so we can reduce our taxes. Remember, expenses, the more expenses we have, it affects our net income. So those two things you can do as it relates to incomes and outgoes. The next two things are as it relates to health. So you can enroll all the way up until, I think it's December 15th, you can enroll into a HSA, a Health Savings Account Eligible Insurance. Now, by enrolling in a HSA eligible insurance plan, you're not going to receive direct tax benefits today in this calendar year 2018, but what it's going to do is it's going to make you eligible for benefits next year, which is going to reduce taxes in 19. See, that's the planning side of me. How can we reduce it in the future? So an HSA, if you're participating in that, it will help you. So you can enroll into an HSA eligible insurance plan. The other thing you can do as it relates to health is you may consider an HRA, an health reimbursement account. And so I've seen this a couple of times with business owners. You need to be a business owner to do this. But let's say that you have a special needs child. I'm thinking of one in particular. And you're covering costs for training or for transferring, for babysitting, for all the things that go with that heavy burden that you carry. And I'm thinking of a very dear friend right now. And all of a sudden you're carrying expenses in the tens of thousands of dollars. Well, a health reimbursement account could potentially be a good solution for you. The challenge is, though, is you have to reimburse your expenses in December of this year. So if you've never heard of an HRA and you're self-employed and you do have high medical expenses, this may be an avenue that you might want to look in. You may not be able to pull it off this year because of cash flows or whatever. Maybe you can. It's something that you want to look at this year. So those are the first four. The fifth thing we can do is we can max out our 401k if we're W-2. So this applies to the S Corp, so the people who are LLC taxed as S Corp. If you're an LLC taxed as an S Corporation or an S Corporation, then you want to go ahead and confirm that you placed in the maximum amount before 12/31 into your 401k. So for those of us under the age of 50, we can do $18,500 for this calendar year 2018. For those of you over the age of 50, you can do $24,500 into your 401k. A good tax saving tip is you can max out your 401k. Another thing you can do from another standpoint, futuristically planning, is you can put your spouse on payroll. Now, what I do is my wife is on payroll. She does some work for us in the company here. And being she's on payroll, we pay her, and then all of her money will go directly into the 401k. We had to make some adjustments in our 401k plan. But now, because she's on payroll, she can place her earnings into the 401k. So think about this. If I'm on payroll, or if I'm taxed at an S Corporation, or if I'm an LLC, I can place $18,500 into the 401k. If I pay my wife $21,000, she works in the company, and then she can place in $18,500 for this year. That's $37,000. Next year, it's actually $38,000 because we get an increase in our contribution amount. So if you have your family, if you have your wife on payroll or your husband on payroll, I'm not trying to be sexist here. I'm just thinking I'm a guy, my wife's Emily, so that's what I'm thinking. But you want to have your spouse on payroll. So that's the sixth thing you can do. Another thing you can do is you can pay your kids. Now, they need to have a legitimate job. They do. They need to be able to do something in your office. Maybe like ours, maybe they come in and they clean the office. Maybe they shred papers. Maybe they take photos for you. My children, they take photos. That's part of our job. As we go throughout their family life, they take photos and they email it to our publishing team. Maybe they're models on your website. There's all sorts, and I'm saying that's all the jobs. There's tons of jobs, legitimate jobs that your children can do. Now, they got to be legitimate. But if you pay your kids, here's where it gets crazy. The new standard deduction is $12,000. So you can pay your kids up to $12,000 a year, and they pay no tax. And depending on the structure that you're in, like we're taxed as a partnership in our company, we do not have to pay FICA and FUTA tax withholding. So there is no withholdings on them. So that's $12,000 potentially that each child could do. So if my children are 36, I have three kids, that's $36,000 of tax-free income that I can create an expense on the company, shift down legally to my kids for the job they do. And if you're a mean dad like me, you can charge them rent. You can charge them for transportation costs. You can charge them for their education. Those things which you typically were paying with after-tax dollars. Now you can use legally, you talk to your CPA, talk to your attorney about this. You can pay your children monies out of the business for a true job, a legitimate job. So you can pay your kids. So now maybe a scenario where you're going to put your kids on payroll. The eighth thing you can do is you can make charitable donations. We all know at the year end, there's typical charities that need funds. So you may stroke a check, you may provide a highly appreciated stock, you may do some sort of a charitable contribution. You want to get those in before 12/31. Now, the number 9 scenario, this is a tax planning going forward for next year that you want to do this year, is you may want to adjust your W-2. One of the things that I'm considering that I try to tell our business owners is this. Let's say that I'm going to just keep it super simple from my brain. Let's say that I make $100,000 in my family. Well, what many people do is they'll say spouse number 1 receives $50,000 and spouse number 2 receives $50,000. The problem with that is that's not a very good use of the way that the Social Security Administration works. You would be better paying spouse number 1 $90,000 and paying spouse number 2 $10,000, and then diverting all that $10,000 to the 401k. Whenever we retire, the way the Social Security Administration works is the lesser paid spouse has the ability, if possible, to collect up to 50% of the gross paid spouse. And I wrote a blog about this. So you may want to consider adjusting your W-2 so you can maximize out your long-term Social Security benefits. That's a tax-saving method. Whenever you also adjust your W-2, I've seen families where they have both husband and wife making $120,000. They're not utilizing Social Security properly. They're not contributing to their 401k properly. And what in effect they're doing is they're both paying either the full amount of self-employment or the full amount of the FICA FUTA tax. Instead, if you will move one spouse to that roughly $100,000, I call it $130,000 range, place that number there, then any amount of money over that $130,000 range, you're taxed only at the Medicare rate, which I think is like 3.5% off the top of my head. So you can adjust your W-2 now and pick up Social Security benefits and potentially pick up savings on self-employment tax or FICA FUTA tax, something you want to consider right now. So those are all the payroll type of things that we can do. So we started with collections, expenses. We dealt with health insurance. We dealt with HSAs or HRAs. We dealt with 401ks, spouse on payroll, kids on payrolls, charitable deductions, adjusting the W-2. All those are payroll type things. Well, charitable may not be, but I threw it in there. The next thing you can do this year is we have a cool tax code now. You can buy a car. Now, talk to your advisor about this, but if you buy an eligible vehicle, you can get a major write-off this year, more so than many times in the past. So you could buy a car this year. Now, that's not a gift for all of us crazy country folk who say, I want to buy me a new truck. I'm not telling you, Justin said, go out and buy you a new truck. I'm saying that talk to your advisor. If you need, the word is need, a new vehicle, now may be the time. Now may be the time. The other thing you can do, and this is a crazy one, is you can actually rent your house to your business. Now, you may not be able to do that in this year. There's actually lots of articles about this. I think it falls underneath it's 203A, section 203A of the code, probably 230A. I can't remember which one it is. Basically, let's put it in this perspective. In East Tennessee, we have the Bristol race. I have clients who will actually rent their house out for less than 14 days to people to come in and rent their house so they can go to the Bristol race and their family go on vacation with that rental money. By doing so, that money they receive for that rental of the house, as long as it's less than 14 days for their primary residence, is tax-free. You can do the same thing in your business. You can actually, now it's got to be all above board. Again, talk to your CPA, talk to your tax attorney about how to do this and if you're eligible based on your structures and everything. But you can actually rent your house to your business for business functions. It's a play that many people will use. In fact, I was listening to a couple of tax attorneys on a podcast, and this was one of their big things. It's like so many self-employed people miss this, is renting your house. The 12th thing you can do is you can bunch your expenses for Schedule A, bunch your expenses. So this year, our itemized deductions have increased. If you're single, it's $12,000. If you're married, it's $24,000. I know that one for sure. I think it's 12 and 24. If for some reason we had a year this year to where you had a lot of expenses, let's say it was medical expenses, or let's say you gave a ton of money to charity and you're getting real close to that $24,000, you may want to look at some expenses for next year. Maybe you call the church up. Maybe you call the church up and say, hey, look, pastor, I know I gave $20,000 this year. I'm going to go ahead and pay the other $20,000 for next year, my tithe for next year now. So you're not getting it next year. And by doing so, you actually make yourself where you can get more itemized deductions. So that's called bunching your expenses. The 13th thing you can do is you may want to consider just the home office standard deduction, the standard deduction. So the rule is that I think it's $1,500 is the standard deduction amount. You cannot deduct any greater than 300 square foot of your house. There's some rules on that. You check the IRS regs. But so many business owners are like, well, I do work at home, but man, I'm not going to go in and calculate a percentage of my power, a percentage of this, a percentage of the room, a percent. You don't have to. You can actually use a standard deduction. And so many people don't realize that that's there. Now, you say, Justin, it's only $1,500. Yeah, it's $1,500. And if you're in a 40% tax bracket, like some of the clients I work with, folks, that's $700, $800. That's the new gun. I mean, you can buy a brand new hunting rifle with that much money. Come on, think about it. So you may want to take the standard deduction on your home, okay? We're going down to 14. Number 14 is you may want to talk to your investment advisor about doing what's called tax loss harvesting. Tax loss harvesting. Think about going out and picking corn out of the field. Same concept. You're going to look at a portfolio. You're going to see which positions are down right now, and you're going to go and pick those. You're going to sell that position, capture that loss. That loss is going to be utilized on your tax return. Now, there's long-term and short-term. I'm not going to get into that in this particular conversation, but you can utilize tax loss harvesting right now. We're actually doing that behind us in this back room over here. People are actually making some trades right now for tax loss harvesting. Now, the 15 thing, what we can do is you can update your books. Now, we talked about this early on. You can update your books. Your books have got to be pristine. You can update your books now for this type of planning, but you can also update your books and records for your home and your family. Those who are the most prepared when you get ready to go meet your tax advisor, your CPA in about 3 months, those of us who are most prepared are placing that professional in a position to where they can look at the maximum amount of savings we can get. So if you use a software like I do, like a QuickBooks for your business or a Quicken or a Mint or a Money or something like that for your home, then you want to go ahead and look at between now and Christmas. I know none of us are busy. I know none of us are, having a hard time right now trying to keep up with what we're dealing with. So let's just go ahead and throw some budgeting on there between now and New Year's. Yeah, reach down, go in and make sure that you have all your different expenses allocated properly, so that as you approach your CPA, your tax advisor, your enrolled agent, whoever that person is, they have all your data in a row, and now they can sit there without having to think about all the different scenarios that you could be potentially eligible for. They're looking at your life, and they can plug those numbers in really good. So those are 15 thus far, 15. So let's do a quick recap. You can stop your billings and collections. You can prepay expenses. You can enroll in your eligible HSA. If you have a lot of health expenses, you could do HRA medical reimbursements. If you don't have that, maybe next year. You can max out your 401ks. You can pay your spouse, your kids on payroll. You can adjust your W-2. You can make charitable donations. You can rent out your house. You can bunch your expenses. You can make the home office standard deduction. You can do tax loss harvesting. You need to get your books and records up to date. Whew, that's a lot. We have 3 more. 16, and these are a little bit more complicated. In 16, you can actually consider, now you're past the deadline for this year, by the way. You should have been doing this a while back. For 16, you can actually consider a defined benefit, defined contribution combo. So this is where a 401k and a cash balance work together. We can actually put those two together. So you want to make sure you're on that right now. Making sure you're talking with your advisors and making sure you understand what a cash balance 401k combination is. Number 17, not for everybody, but you could consider a conservation easement. This is a charitable deduction that you're able to actually make charitable contributions into land, which typically provides you a benefit for charitable a tax benefit on your 1040 return on Schedule A. It actually works really well whenever you start bunching expenses on Schedule A. That's number 17. Most complicated is number 18. This is called the Opportunity Zone investment, or the O Zone. So this is for those individuals who may have sold a business this year. This is for those individuals who have a ton of capital gains. Maybe they sold a piece of real estate. Maybe they sold a piece of equipment. You know, some of this mining equipment for some of our clients are multi 10-figure numbers. So if you're in that area, you can actually participate in opportunity zone, or what they call now ozone. So where you're going to move your money to a particular area in the new tax law that allows you to make some maximum tax savings. Woo, folks, that's a lot of data. So there's 18 ways that you can drop or reduce your taxes, crazy things you can do. All of them are above board. Talk to your CPA, talk to your advisor. Please do not take my advice. I'm not telling you to go out and do 18 things. No, I'm saying just consider these and approach these ideas with your professional, but now's the time to do it. Now's the time you want to be on the phone with your professionals. Hey guys, I know it's a lot of data, 20 minutes of a live video here. I know everybody's just been waiting for this 18 things you can do to reduce your taxes. I did the 17 things last year in 17. 19 is going to be, it's getting more and more every year. We're going to figure it out. I know we got Christmas coming up. So guys, just remember, life is good. Life is complicated. I get it. Life is frustrating. Money doesn't have to be. Taxes, it's easy stuff. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.